Hello, this is Dean Malone with Compass FX. Hope you're doing well today and again some good trades. Today I'm going to talk about something that is advanced for some traders and may not be the right fit, and that is catching reversals in the marketplace using the TDI. I often refer to this as the TDI hook in some of my advanced training, but something that happens over and over in the marketplace. However, it can get you caught on the wrong side of the market if you're not paying attention to some other factors in the marketplace. So what I want to do right now is to go over a potential reversal trade using the TDI, the Traders Dynamic Index indicator. So let's get started here on the dollar CAD, and what we're specifically looking for is when the green line goes beyond the 68 or goes beyond the 32 and then starts to make what I call a hook back towards the center. You can notice here we come below the 32 right here and we go beyond the blue volatility band. And then we hook back up. That right there is a potential reversal signal back to center, back towards the 50, where market sentiment tends to get back to right around that 50 level. You can see here also that the market went up pretty high today, came back over, and started falling back down. Again, this is what I refer to as a hook, where the TDI is kind of like an upside down fish hook right here, or this being a fish hook like so, coming to the upside. So again, we go below the 32 and back up, or we go beyond the 68 and we turn back to the downside. Now again, you got to be cognizant of what the market's doing overall and look to see, is the market stretched one way or the other. In this case, we've made new lows in price. Price bounces around a bit and makes more or less a double bottom here. You can see how the market came down here, bounced up to a midpoint, comes back down to a bottom, and then we get this move back up. So we get a double bottom in price, which represents a long bias or an upward move. At the same time, we get this hook here. The significance is that the green line is coming outside the blue volatility band. We have it up here as well. Now this is an advanced concept and may not be right for some traders. And let me show you the good and the bad of using this particular type of technique. If we take a look at the Aussie CAD, you can see today that we had a nice reversal signal occur right here. Now again, the green line's below the 32, beyond the blue volatility band, comes down and we hook back up. If we look at price here at the same time, it followed. It kind of flattened down a bit, but then made its push on up. Had this turned over and fallen back down, we would be trapped in a long with the market overall going down. So you got to be careful of that, because if we take a look at the Aussie dollar today on the 30-minute chart had a TDI hook set up right there. Again, green line coming below the blue volatility band, below the 32, and starting to hook back up. But look what happened in price. We made a move down, we bounced around, then it threw a pin low, came back, and then continued to push on down. So it wasn't quite ready yet to turn to the upside. So if you got in on this crossover right here, playing this back up with the green crossed over the red, back up here, and you got in, let's say somewhere around 236, this moved against you about 80 pips to the downside. So you got to be very careful. Now today, the euro dollar, the pound dollar, and the Aussie dollar were very strong to the downside due to some of the European debt crisis, especially related to the Italian bonds reaching 7.5% on their yield today. And with the Dow futures down to negative 225, we saw the Dow itself continually drop today, and that put pressure on the Aussie dollar and the euro dollar and the pound dollar to the downside. So again, you want to factor in what's going on in the marketplace before you elect to trade a reversal type signal. So again, let me go back to the dollar CAD and review with you the steps in this advanced technique. You look for the green line of the TDI to drop below the 32 and start to hook back up. Your entry is going to be when the green line goes back above the red. In this case, you're looking to enter the market in that area. Now again, the whole market's still coming down against you. What you're trying to do is you're trying to catch the bottom and trade it up. Same thing on the opposite to the upside. The green line goes beyond the blue volatility band, goes up, and you would be trading this to the upside on a volatility band break that I talked about yesterday. But this pushes up, goes way up above the 68, and then breaks and closes below the blue volatility band, crosses the red line, the trade signal line, and at this point now you're looking to potentially short this to the downside. Be aware though that the market is pushing up. What we're looking for has price stretched to a low point and has price stretched to a high point. One of the things you can use to help you identify the high to low is to look at the average daily range. We can see here that the CAD today had a move of about 153, 154 pips. When its average daily range is inside of that, the average daily range sitting around 120 pips, it's gone beyond. So the thought is that this traded itself up. When it reached beyond the average daily range, usually a currency pair will turn and go back into its average daily range. And if you see the reversal setup here, which I call the TDI hook, there's a possibility of taking some pips in the market. Now remember, when you trade reversals, that you're not looking for a long-term trade here. You're looking to get in and then potentially get out to avoid the market doing a turn on you like this. Now in this case, the market did move up but eventually turned back down. So be ready for a potential turn. So in this case, when the market started going up from this area and started making a push up, there was only about 20 pips there before the market started falling back down. And in this case, if the market drops and breaks the previous low where your stop would be, you'd be getting out of that trade. So in this case, as you go long, your stop would be underneath here. In this case, like over here, we would be going short. You see how the green line comes up over the blue volatility band, back in, and you start trading short as it crosses the green. Then what we would do in that case, right about there, we'd put our stop above the high point here. That's how you know where to place your stop loss for that trade. So folks, you can use this technique. It's not for everybody. It is a reversal technique to catch the bottoms and catch the tops in the marketplace. You're looking for the market to get real weak at the bottom and start to turn long, or you're looking for the market to get real weak, overbought way up high, and looking for it to turn back over to catch some pips the other way. Well folks, this is D Malone with Compass FX. Hope some of this information has helped you in your trading. Y'all make it a great day and get some good trades. We'll talk to you next time. Bye-bye.